Complacency in the stock market be damned. If the past is precedent, then stocks have another 8 months of gains ahead. So back up the truck on stocks because this party may just be getting started. Historically, when the S&P 500 notches a 10% plus first quarter increase, it's been 13% so far this year, it leads to a continuation of gains the rest of the year, says SunTrust chief market strategist Keith Lerner. Lerner's research finds that in the 10 instances since 1961 where 10% plus first quarter increases have been notched in the S&P 500, the rest of the year was up 9 times. That's impressive. Lerner further stated that this should not be looked at in a vacuum. Still, the broader point is that stronger market returns to start the year tend to be a positive factor. So, the stage is set for further gains this year, too, Lerner thinks. A combination of a lack of euphoria among investors, low interest rates, and an S&P 500 stock valuations below their early 2018 peaks could be positive stock drivers. Oh, but wait, I've just been handed a note. This from strategist Serena Tang of Morgan Stanley. The note reads that Morgan Stanley's U.S. market cycle indicator is still in expansion, a phase which it has been in since 2014. But now the bank is estimating that there is a 70% likelihood that this will shift to downturn over the next 12 months. Further, if the recent deterioration in data persists, we could see a switch from expansion to downturn as early as next month. As Tang explains, while such turns do not necessarily mean recession, they do correspond to materially worse return environments for credit and equities. And so, coupled with generally low bottom up returns from Morgan Stanley strategists' forecasts, the bank leans back against dreams of Goldilocks and believes that this supports more defensive asset allocation. According to Tang, Morgan Stanley doesn't think that the current expansion can be sustained for long. As this chart here shows, our real-time downturn probability gauge estimates the chance of our cycle model inflecting to downturn from expansion within the next 12 months based on historical experience. What this chart suggests is that given the level of the cycle indicator, the chance of a shift to downturn over the next 12 months is elevated at close to 70%, up from 60% from the end of 2017. As a result, the probability of the U.S. cycle indicator switching from expansion to downturn is the most elevated it's been since 2005-2006, suggesting an imminent cycle peak. In fact, a backtest shows the probability of a downturn is now higher than it was either right before the global financial crisis or just before the dot-com bust. If Morgan Stanley is correct, what does this mean for assets? The bank explains that downturns tend to see stocks and credit underperform while bonds outperform. This contrasts to an expansion where equities benefit from a boost to returns from the cycle. Ironically, the key driver behind this prediction is that the strong, unbroken run of improving data over the last year has been the main culprit. Specifically, since April 2010, we've not had a 6-month period where a majority of the components of the cycle indicator were not improving. It is, to our knowledge, the longest streak in history, and that is the point. Things can't get much better, and Morgan Stanley believes that we are near an inflection point to where the economy and the markets turn negative. In Morgan Stanley's words, our market cycle indicator and the probability gauge are very clear. An inflection from expansion to downturn is on the horizon. After all, what goes up must come down. So maybe the party is over. But maybe we need to keep an objective view of the markets and not let the talking heads tell us where we need to be. Continue to do your own research and you will be miles ahead of the pack. And one last item here. Beginning next week, I'll be bringing you the market update on Saturdays. That will give me more time for analysis as things are getting more serious. So for today, that's ChewDog Charts. Thank you.